A very good evening to all the participants of this webinar, which is part 2 of measurement and valuation principles, part 1 of which we did in the earlier webinar in the morning. And we were doing the important valuation principles. And as we had said that there are 4 generally accepted measurement bases, or what we call the valuation principles. And those are historical cost, current cost, realizable value, and present value. So we had done historical cost and current cost in the morning. For the benefit of those who had missed out on current cost, let me just repeat it once again. Now let us say that Mr. X has purchased a machine on 1st of January 2000 for rupees 7 lakhs. If we go by the historical cost base, then he will have to record it at rupees 7 lakhs, which is the acquisition price in his books of accounts. However, as on 1/1/2011, Mr. X found that it would cost 25 lakh rupees to purchase that same machine. If we also take that Mr. X took a loan from a bank on the same date when he had purchased the machine for 7 lakh, that is 1/1/2000. If we take it that he had also taken a loan of rupees 5 lakh on that day, perhaps to buy the machine, and on that 18% per annum interest rate was repayable at the end of the 15th year. I mean, that loan was repayable in 15 years' time at the rate of interest rate of 18% per annum of interest. And let us say that on 1/1/2011, that is after 11 years of the taking of the loan, the bank announces that it will charge 1% prepayment penalty on the loan amount if that loan amount was prepaid within 15 days, starting from the day of the announcement of the prepayment penalty. So under these conditions, if we go by historical cost, the liability of the loan would be recorded at rupees 5 lakhs. That is at the amount or proceeds which were received in exchange for the obligation. And if we were to record the asset at historical cost, it would be recorded at 7 lakh rupees. So on historical cost basis, the liability of the loan would be recorded at 5 lakh rupees, and the asset would be recorded at 7 lakh rupees. However, if we go by the current cost base, then we have to add 1% to the 5 lakh, which is the prepayment penalty, and 1% of it comes to 5,000. So total amount of value of the bank loan as on 1/1/2011, we go by the current cost on 1/1/2011, we would have to record it at 5,05,000 rupees, including the 1% prepayment penalty. And on 1/1/2011, if the current cost base is considered, then machine would be valued at 25 lakh rupees, because that is the rate at which it can be purchased on that day, which is the current cost of the machine on 1/1/2011. So as you can see that if we were to take the historical cost basis, the valuation is quite different from if we were to take the current cost basis. Now let's look at the third principle or the third measurement base. Now let's say that Mr. X found that he can get 20 lakh rupees if he would sell the machine purchased on 1/1/2000, paying 7 lakh rupees, and which would cost 25 lakh rupees in case he would buy it currently. So here there is a difference from the current cost where Mr. X is finding that if he had purchased the machine on 1/1/2000, the cost would be 7 lakh rupees. And if the same machine was purchased on 1/1/2011, that is after 11 years, it would cost 25 lakh rupees. But if he thinks that if he is going to sell that machine on 1/1/2011, he thinks he can get 20 lakhs for it because of obviously the machine has been used also earlier. So in such a situation, if you also take that Mr. X also found out that he had no money to pay off the bank loan of rupees 5 lakh currently, he cannot pay off that bank loan of 5 lakh rupees. So if we were to go by the realizable value, assets are carried at the amount of the cash or the cash equivalent that could currently be obtained by selling the asset in an orderly disposal, the proper disposal, not in a sudden disposal of the assets. If in a sudden disposal, the rate would be quite different or quite low. But if there is an orderly disposal of the asset, what would be the price that could be realized by selling it by an orderly disposal? So that cash equivalent would be the realizable value. If we do a haphazard disposal, the yield may be something less than the orderly disposal yield or the realizable value. On the other hand, liabilities are carried on the basis of realizable value at settlement values. That is the undiscounted amount of cash or cash equivalents which is expressed to be paid to satisfy the liability in the normal course of the business. If there is a liability in the normal course of business, a certain X amount can be paid to satisfy that liability. Then that amount is the settlement value of that liability, and as per realizable value base, the settlement value is supposed to be taken in case of the liability. So the machine which was purchased on 7 lakh rupees, but on 1/1/2011 it can be sold to realize only 20 lakh rupees. The realizable value of the machine on 1/1/2011 is 20 lakh rupees, and therefore 20 lakh rupees would be taken to be the realizable value on 1/1/2011 in an orderly sale, while the bank loan should be recorded at 5 lakh rupees, which is the settlement value of that bank loan in the normal course of the business. That if he pays 5 lakh rupees, the loan will be settled. So if we were to go by the realizable value, on 1/1/2011, the machine would be recorded at 20 lakh rupees and loan would be recorded at 5 lakh rupees. And as we have seen that if we were to go by current cost basis, the machine would be recorded at 25 lakh rupees and the bank loan at 5,05,000 rupees, whereas if we were to go by the historical cost basis, the machine would be recorded at 7 lakh rupees and the loan would be recorded at 5 lakh rupees. Now the fourth basis of measurement is the present value. Now supposing we are talking as on 1/1/2011, which is the time for the reference. Now let us think that the machine which was purchased by Mr. X that machine can work for another 10 years as per Mr. X's opinion, and it is supposed to generate cash of rupees 1 lakh rupees every year or per annum for the next 10 years. And also take that the bank loan of 5 lakh rupees, which was taken by X, is to be repaid as on 31/12/2015, which is after 5 years. So in that case, the annual interest on the bank loan is, let's say, 90,000 rupees. So going by the rate of 18%. So now, if we go by the present value basis, measurement base, an asset is carried at the present discounted value of the future net cash flow. If we go by present value, we are discounting the future net cash inflows that the item is expected to generate in the normal course of business, and that present discounted value will be considered to be the present value of that asset. On the other hand, if we go by the present value measurement base or the present value valuation principle, liabilities will be carried at the present discounted value of the future net cash outflows that are expected to be required to settle the liabilities in the normal course of the business. So assets have to be taken at the discounted value of the net cash inflows, and the liabilities have to be taken at the discounted value of the net cash outflows. So the term discount or cash inflow and cash outflow have to be understood. Now let us say that rupees 100, which is in my hand as on 1/1/2011, will not be equivalent to rupees 100 in my hand on 31/12/2011, because there is a time gap of 1 year between 1/1/2011 and 31/12/2011. Now let's say that Mr. X had rupees 100 as on 1/1/2011, and he could use it at that time for his purpose. But if he receives this rupees 100 only on 31/12/2011, he could not have used it throughout the year from 1/1/2011 to 31/12/2011. So he had to sacrifice his use of that rupees 100 for 1 year. So since he had to sacrifice his usage for 1 year of rupees 100, there is a value to his sacrifice. The value of his sacrifice is called the time value of money. Mr. X would sacrifice, that is, he would agree to take money on 31/12/2011 if he was compensated for that sacrifice. So a man who goes by reason and logic, that is a rational man, will never exchange rupees 100 as on 1/1/2011 with 100 rupees to be received on 31/12/2011. He will say, give me this 100 rupees on 1/1/2011, not on 31/12/2011. I am not going to wait for 1 year, because rupees 100 of 1/1/2011 is not equivalent to rupees 100 of 31/12/2011. Now, to make the money receivable at a future date equal with the money of the present date, this money has to be devalued. So such devaluation is called discounting of the future money. Now, if I am getting rupees 100 on 1/1/2011, and if somebody is telling me, okay, how much do you want on 31/12/2011? I'll say, okay, give me 110. So therefore, I've discounted the future money, or I've devalued the future money. If I were to consider rupees 100 in the present day, perhaps we know that the compound interest rule is amount equal to principal into 1 plus interest into n. N is the number of periods or time, and I is the interest rate upon 100. Now this equation gives the relationship between the present money, the principal amount, present money is the amount A, the principal P, and the future money amount. So if A, I, and N are given to me to find out P, I think I can use this equation after changing this equation a little bit. Now the equation would be P equal to, I'm just using the same equation, P equal to A upon 1 plus I raised to the power n. There is a slight change in the equation here. So if I were to carry out the mathematics, I can prove this equation. Now using this equation, one can find out the present value. Present value is P. If he knows the values of A, I, and N, that is N is the number of periods of time, I is the rate upon 100. So if I is equal to 20%, so now what is the present value of 1 lakh rupees, which is to be received on 31/12/2011? How much is the present value on 1/1/2011? So we can apply this formula, P equal to 1 lakh upon 1 plus 2 raised to the power n, which is 1. And I arrive at a figure of 83,333. So 1 lakh rupees on 31/12/2011 is equivalent to 83,333 on 1/1/2011. Similarly, we can find out the present value of rupees 1 lakh as on the dates which are mentioned on the left hand side column. I can say that rupees 1 lakh of 31/12/2020 is equivalent to rupees 16,150 on 1/1/2011. Now, if we take a total of all the present values, that is coming to 4,19,246, which is the third column. And since the machine was purchased by Mr. X, will produce the cash equivalent to 4,19,246 in terms of the present value. We are saying that the machine will produce 1 lakh rupees every year, as we had seen. That is in terms of the value of that year, but in terms of the present value, the machine is going to generate an inflow of cash of rupees 4,19,246 for the businessman. So in that situation, it has to be valued at rupees 4,19,246. Here Mr. X will receive rupees 1 lakh at different points of time, because those are the cash inflows of every year. Now in the other example, he has to pay interest. That is, when he's taken loan, he has to pay interest and the principal of the bank loan, and which are the cash outflows. So to calculate that, we have the annuity rule. That is present value of an annuity. Annuity means annual outflow. The present value of an annuity or rupees A for n periods can be calculated by this formula, where A is the annuity, I is the interest rate, and 1 minus 1 upon 1 plus I raised to the power n, where n is the number of periods of time. So if we apply this rule, we can derive the present value. If we are paying 1 lakh rupees for 10 years at 20% per annum, then we can derive this value of rupees 4,19,246 rupees, which is the present value of 1 lakh paid for every year for the next 10 years. So as we can see that we are coming to the same conclusion, the same figure which we saw in the case of an outflow, the same figure is coming for the inflow. The formula was also relatively similar. So therefore, we can say the present value of the bank loan, in case we have to calculate the bank loan, we have to put a figure of 90,000 here, and to calculate the present value of the bank loan, we are putting this formula 90,000 upon 0.20, the 90,000 is the outflow, and 1 minus 1 upon 1 plus 0.20 at the 20% rate is for 5 years, because here in our example, as we have seen, the example of the bank loan, it has to be paid in 5 years' time. So for 5 years, we are calculating the present value of the bank loan like this. We are applying this particular formula, the annuity formula, and then we are getting a figure of rupees 4,70,094. So therefore, we get 4 measurements as on 1/1/2011. If we are tabulating all those 4 costs that we have calculated so far, the machine cost is coming on the historical cost basis at 7 lakh rupees. The machine cost is coming on current cost basis 25 lakh rupees, realizable value basis 20 lakh rupees, and the present value base, on the present value base, it is coming at 4,19,246 rupees. So, and the bank loan, as far as bank loan is concerned, on historical cost basis, but because loan amount is 5 lakh rupees, current cost basis it is 5,05,000 including the penalty, realizable value basis 5 lakh rupees again, and present value basis as we have calculated here 4,70,094. That is the present value of the bank loan of 5 lakh rupees. So therefore, the accounting system which we shall discuss in the future is called the historical cost accounting. However, that does not mean that one will always follow the historical cost basis for accounting. We know that sometimes these other methods are also used for different other kinds of situations. Although under the traditional system, most of the transactions and events are measured in terms of the historical costs, but under the modern systems, sometimes we have to use the other bases like current cost, realizable value, or present value, which we'll be seeing from time to time. But as you can see that the valuation figures of all these 4 valuation principles or the bases are coming out to be quite different from each other. And therefore, we have to be careful which is the most beneficial or the most suitable, appropriate basis that we are going to use for measurement in the given circumstances. We'll be looking at it as we move forward. Now, value means benefits to be derived from the objects, abilities, or the ideas. For an economist, the word value is the satisfaction level or the utility of an economic resource, of any resource of the economy. What is the utility to a person who's contemplating or enjoying its use? That is, value is utility for economist. In accounting, the mean value of an object, ability, or ideas, we use a monetary surrogate, and a monetary alternative for that. That is to say that we measure value in terms of money in accounting. You can say that money is not everything, but for accounting, money is everything. Supposing an individual purchases a car by paying 2,50,000 rupees. Now, the value of the car lies in the satisfaction to be derived by that individual using the car in the future. Economists often use ordinal scale to indicate the level of satisfaction, but accountants will use only the cardinal scales. If the value of the car is taken as 2,50,000, it is only one type of value, which is called acquisition cost or historical cost. So value is indicated by the measurement that we are doing. In accounting, the value is always measured in terms of the money. So that is how we say that accountants use only cardinal scales. The economists place super value or ordinal scales, which means that how much of satisfaction that is going to be derived out of that thing. But for an accountant, it is plain money value, which is the real value. They just go by the number. Now, in this unit, we have learned how to measure a transaction which had already taken place and for which either some value or money has been paid, or some valuation principle have to be adopted for their measurement. But of course, there are certain items for the future which have not occurred at all, and therefore they cannot be measured using the valuation principles. Still they are necessary to record in the books of accounts. There are certain items which have not occurred, but we have to record them in the books of accounts. For example, we are making a provision for doubtful debts. Now, we don't know how much of the debts will go bad, but we have to make a provision on an estimated basis. So we are going to estimate how much provision we are going to make out of the entire debts, how much of the provision we have to make for doubtful debts. And for such items, we need some value. So therefore, we are needing this value for the future, not for the past. In such a situation, reasonable estimate has to be made, which is based on the existing situation, where we are looking at the existing situation scenario, and we are looking at the past experience. Looking at the present and the past, we are estimating the future. That is, of course, always we are doing that in life also. The measurement of certain assets and liabilities is based on estimates of the uncertain future events. Future events are always uncertain, so we have to estimate them, and therefore certain assets and liabilities are there whose measurement will depend upon an uncertain estimate of an uncertain future event. As a result of the uncertainties which are inherent in the business activities, many financial statement items cannot be measured with precision, and they can only be estimated. Therefore, the management makes various estimates and various assumptions of assets, liabilities, incomes, expenses when it is preparing the financial statements. Every management makes estimates and assumptions. Now, such estimates are made in connection with the depreciation or in connection with amortization or in connection with impairment losses, as well as for accruals, provisions, and employee benefit obligations. These are the various matters where future estimates are made. Also, estimates may be required in determining the bad debts or the useful life. Estimates may also be required for calculating the residual value of an item of plant and machinery. कितने सालों के बाद कितनी वैल्यू बची है, residual value. And to estimate the inventory obsolescence, how much of the inventory value has become obsolete. It has become of no value, will not fetch anything. Estimates are required for that. How much is the useful life of an asset remaining? So for all these things, we have to make estimates. What will be the employee benefit obligation in the future? How many employees will have to be paid how much amount in the future years in respect of employee benefits? What will be the future accruals? What will be the provisions that will be required in the future? So we have to make a lot of estimates. The accountant has to make estimates. The process of estimation will involve a judgment, and the judgment will be based on the latest information that is available to the accountant. Now, an estimate may require the revision if changes occur. We have made an estimate, but the estimate will may be needed to be changed because circumstances have changed on which the estimate was based, or because some new information has come into the picture, or maybe experience has improved, or some subsequent developments have taken place, and therefore revision of the estimate is required. Now, change in an accounting estimate means a difference which is arising between certain parameters which were estimated earlier and which are now re-estimated during the current period, or actual result which is achieved during the current period. Either the re-estimate is based upon a reappraisal of the parameters which were valued or estimated earlier, or the estimates could be changed due to the actual result which was achieved during the current period. Now let us take a few examples of the situations where accounting estimates are needed. Number one example is a company incurs an expenditure of rupees 10 lakh rupees because it is developing a patent. Patent is kind of a right to hold the or to sell the process of developing a certain product or making a certain product. Now the company has to estimate that for how many years the patent would benefit the company. This estimate company has to make for itself. This patent is going to benefit the company for how many years before some other better patent comes into the market. Now this estimation should be based on the latest information and on the logical judgment of the company. Similarly, a company which is dealing in long-term construction contract, it uses the percentage of completion method for recognizing the revenue at the end of the accounting year. It estimates how much percentage of a project has been completed, and based on that percentage, it recognizes the advance received as the revenue for that year. And under this method, the company has to make adequate provision for unseen contingencies also. because some unforeseen contingencies or situations may arise, which can take place while executing the remaining portion of the contract. Now, therefore, it has to make some estimate of the unseen contingencies. Since provisioning for unseen contingencies requires estimation, there may be excess provisioning or short provisioning. Now, if the provision which is made is not if short, then it will have to be adjusted in the future. If it is more than required, that may also have to be adjusted. So this adjustment is to be made on the basis of the current estimate. Now the company has to provide for taxes also. It has to make provision for payment of taxes, which is also based on its estimation, as there can be some interpretational difference on account of due to which the tax authorities may either accept the expenditure shown by the company or may refuse it. So they have to estimate, the company has to estimate as to how much of the expenditure that it has claimed will be allowed by the tax authorities ultimately, or by the courts. This will ultimately, therefore, this estimate will lead to a different tax liability. If the estimate becomes different, if the estimate changes, then the tax liability also changes. Or as the tax liability estimate changes, the provision changes for the tax liability. So therefore, in all these situations, we have to make estimates in the accounting system while recording the entries. So therefore, we come to a few questions, and let's, at the end of this particular unit, let's do a few questions here. The first question is, the measurement discipline deals with what? Identification of the objects and events, selection of the scale, both A and B. And as we have seen, the measurement discipline deals with both of these things: identification of objects and events and selection of scale. Number 2, all of the following are valuation principles except. We have seen that historical cost and present value are the valuation principle, but future value is not a valuation principle. So here C would be the answer. The third question here is that the book value of a machinery on 31st March 2016 is rupees 10 lakh rupees, and the market value as on the same day is 11 lakh rupees. Now, as on 31st March 2016, the company values the machinery at 11 lakh rupees. So which valuation principle it is following? Obviously, it is not following the historical cost because the book value is 10 lakh rupees, but it's not following 10 lakh. It is following 11 lakh, which is the realizable value. And therefore, we can say that this company is following the realizable value principle. Now, let's look at another question. Mohan purchased a machinery amounting to rupees 10 lakh rupees on 1st of April 2001. On 31st March 2016, a similar machinery could be purchased for rupees 20 lakh rupees, but the realizable value of the machinery, of the same machinery which was purchased on 1/4/2001 for 10 lakh rupees, was estimated at 15 lakh rupees. The present discounted value or the present value of the future net cash inflows that the machinery was expected to generate in the normal course of business was calculated at 12 lakh rupees. So in this example, what is the current cost of the machine? Current cost is based upon the current cost principle, that is at what price the machinery can be purchased currently. So as the machinery can be purchased for rupees 20 lakhs rupees currently, 20 lakh rupees is the current cost. Now the next question is, what is the present value of this machinery? Present value is the discounted value of the future net cash flows. So that is 12 lakh rupees. And that is the answer for this present value. If we say what is the historical cost of the machinery, historical cost of machinery is 10 lakh rupees. And if you were to ask what is the realizable value of the machinery, realizable value of the machinery is, if the machinery is sold as on 31st March 2016, what would be the estimated price that it will fetch? That is 15 lakh rupees. So realizable value is 15 lakh rupees in this case. So with that, we have done a bit of a revision of the entire chapter. And so we have come to the end of this chapter. And with that, we come to the end of today evening's webinar also. Thank you very much for joining us for this webinar.